Most people think investing fails because they picked the wrong stock. But the data tells a different story. The biggest reason people fail at investing is much simpler. They quit during the boring part, the part where the balance barely moves, the part where the market suddenly drops 20%, the part where you start wondering if any of this is actually working. This stage has a name. You could call it the death valley of compounding. It's the stretch between 1,000 and about 20,000 invested. And here's the strange truth. If you can survive that valley, the rest of the journey becomes dramatically easier. Why most people quit here? Here's what usually happens. Someone decides to start investing. They open an account. They deposit a few $100s, maybe even a few thousand. At first, everything feels exciting. They check the account every day. They watch finance videos. They imagine what their portfolio might look like years from now. But then reality appears. The market drops 10%, then 15%. Suddenly, that $1,000 investment becomes $800 or $700. And that's the moment doubt appears. People start thinking, maybe I started at the wrong time. Maybe the market is too risky. Maybe I should wait until things stabilize. But the truth is that this stage is completely normal. Every long-term investor goes through it. The difference is simple. Some people see volatility as a signal to quit. Others see it as the price of admission for long-term growth. The psychology of the boring start. When you first begin investing, the numbers are underwhelming. Imagine you invest $100 per month. After 1 year, you've invested $1,200. If the market grows around 8%, you might earn $50. Maybe $80. That's it. Not exactly life-changing. Now compare that with something completely normal. Buying a $1,200 smartphone every year. Most people don't even think about it. But there's a hidden opportunity cost behind that habit. If that same $100 per month went into a simple index fund instead, the story starts to look very different. After 10 years, you would have invested about $12,000. With average market returns, that account might grow to roughly $18,000. Nice, but still not extraordinary. Now stretch the timeline to 30 years. You would have invested $36,000. Yet the portfolio could grow to around $150,000. Same monthly habit, same amount of money. But the outcome is now more than 4 times what you actually contributed. And here's the surprising part. Most of that growth doesn't happen in the beginning. It happens in the later years, which means people who quit early never reach the stage where compounding becomes powerful. The early years of investing feel strange. You're doing everything correctly. You're saving regularly. You're investing consistently. And yet the progress still feels slow. This happens because compounding behaves differently at the beginning. In the early stages, effort does almost all of the work. Later on, the money starts doing the work instead. And that shift tends to happen across 3 quiet milestones. Stage 1. The first meaningful milestone is 1,000 invested. Not because of the number itself, but because reaching it proves something important. The system is working. Money is being set aside. Contributions are happening automatically. And the habit has started to take shape. At this point, the portfolio barely moves. A few dollars here, a few dollars there. Sometimes it even drops below the amount you invested. That can feel discouraging. But the goal of this stage isn't growth. The goal is stability. Once the habit exists, progress becomes far easier to repeat. Over time, those small deposits accumulate, month by month, year after year. Eventually, the balance reaches a point where the numbers begin to behave differently. Stage 2. At $10,000, the scale begins to change. Market movements no longer show up as tiny amounts. Now they start appearing in hundreds of dollars across a year. The portfolio feels more alive. Sometimes the balance rises even during months when no new money was added. That's the first visible hint of compounding. The investor is still doing most of the work, but the portfolio has begun contributing as well. And that changes the psychology completely. Because progress is no longer theoretical, it becomes observable. As the balance grows further, the relationship between effort and growth starts shifting again. This is the stage where investing stops feeling like constant pushing and begins to feel like momentum. Stage 3. When the portfolio approaches $20,000, the dynamics change once more. With an average market return around 8%, that balance produces roughly $1,600 per year. That's about $130 per month. The portfolio is now generating movement on its own. Not enough to live on, but enough to notice. And once that happens, the process starts feeling different. Growth appears more frequently. Small market increases translate into meaningful dollar changes. The system begins helping push itself forward. Momentum starts to build. The strange part is that most investors never reach this stage. Not because the math is complicated, but because the beginning feels too slow. The stretch between $1,000 and $20,000 tests patience more than anything else. It's quiet, uneventful, and easy to abandon. But it's also the exact point where the foundation of compounding is being built. And once that foundation exists, the mathematics of growth begin to take over, which leads to one of the simplest formulas in investing. A rule that explains how money doubles over time. The rule of 72. You divide 72 by your expected annual return. The result tells you roughly how many years it takes for your money to double. At an 8% return, your money doubles approximately every 9 years. Consider a simple sequence. 10,000 becomes 20. 20 becomes 40. 40 becomes 80. 80 becomes 160. The pattern is obvious. What matters isn't the specific numbers. It's the structure of doubling. Each cycle builds on a larger base, so the absolute gains grow dramatically over time. The move from 10 to 20,000 adds $10,000. The move from 80 to 160 adds 80,000. Same return, very different outcome. This is why compounding feels slow in the beginning. The percentages are working, but the base is still small. Given enough time, that relationship flips. The base grows large enough that even ordinary returns begin producing meaningful changes. And this example assumes no additional contributions at all. In reality, investors usually continue adding money along the way, which means the compounding process is constantly being reinforced. Over long horizons, that combination of time, consistency, and exponential growth becomes extraordinarily powerful. The simple index fund strategy. Many long-term investors avoid trying to pick individual stocks. Instead, they invest in broad index funds. These funds track large sections of the stock market. They are low-cost, diversified, and extremely simple. One common approach is investing in funds that track the 500 largest companies in the United States. Another approach is investing in funds that track the entire U.S. stock market, including thousands of companies, both large and small. Some investors go even further by investing in global index funds that include companies from all around the world. Instead of betting on one company, one industry, or one country, you're investing in the long-term growth of the global economy itself. What long-term data shows about investors. Decades of market history reveal a simple pattern. The biggest advantage investors can have is not intelligence, it's discipline. The investors who succeed over long periods are usually the ones who stay invested through market ups and downs. They avoid reacting to headlines. They resist the urge to constantly buy and sell. There's a well-known idea in investing that inactive accounts often perform surprisingly well. Not because the investors were brilliant, but because they simply left their investments alone. Another observation from long-term market data is that missing just a handful of the market's best days can dramatically reduce overall returns. And those best days often occur very close to the worst days, which means investors who panic and exit the market during downturns often miss the powerful rebounds that follow. One of the hardest parts of investing is learning how to think about market crashes. When markets fall, the headlines become dramatic. Words like crisis, panic, and meltdown appear everywhere. But long-term investors eventually learn to see those moments differently. Imagine walking into a store where everything is suddenly 20 or 30% cheaper. Most people would call that a sale. But when the stock market goes on sale, people suddenly become afraid to buy. This psychological flip is one of the biggest challenges in investing. Over long periods of time, markets have experienced recessions, financial crises, wars, inflation, and political instability. Yet the overall trend has still moved upward, not in a straight line, but in a slow and persistent climb driven by innovation, productivity, and economic growth. Volatility is not a flaw in the system. It is simply part of the journey. What success actually looks like. Real investing success looks very different from what social media usually shows. It does not look like day trading. It does not look like chasing viral stocks. And it rarely looks dramatic. Instead, success looks boring. It looks like automatic monthly contributions. It looks like ignoring daily financial headlines. It looks like viewing market crashes as temporary discounts instead of disasters. If you can consistently do those three things, you are already ahead of most investors. Because investing isn't about predicting the future. It's about giving compounding enough time to work. And the people who eventually build large portfolios usually started the exact same way, with the most unimpressive number in investing: the first $1,000. Thanks for watching.